A few days ago, Deutsche Bank came out with a new report that looks at 200 years of US data and concludes that we are in for a very severe recession with a, quote, 100% probability. So can we turn this thing around? Now, Deutsche leads with the important detail that not only are banks crashing on the biggest scale since the 1930s, the US money supply is also shrinking at the fastest scale since the 1930s. Of course, one major difference is that in the 1930s, we did not have nearly the levels of government debt that we have today. In fact, the federal debt was under 20% of GDP going into the Depression. Today, it is over 100% of GDP, and according to Congress's own number crunchers, is on its way to 200%. That both drains resources out of the economy, and it is supporting the higher tax rates that shift resources from the private sector that could help us recover from the economy and over to the deadweight black hole that is government spending. Now, the one strand of hope might be that policymakers are not as dumb as they were in the 1930s when both parties united to destroy the economy with central planning instead of the natural mechanisms that economies use to fix themselves. Sadly, given the Biden administration's boneheaded decisions over the past 2 years, from energy to spending to equity, if anything, policymakers are probably stupider. In their report, Deutsche was especially worried about real estate, both commercial, which is threatening to crash, and residential, which has now turned in its biggest drop since the 2008 crisis. They piled on with some rough numbers from Conference Board on the economy, falling household savings, rising consumer credit, and banks that are not lending. Finally, Deutsche notes what every school of economics knows, yes, even the Keynesians, which is that interest rate hikes on the scale of these past few years lead every time to severe recession, if not depression. By the way, this has been the pattern for literally centuries, ever since central bankers took control of the single most important price in the economy, the price of time, also known as the interest rate. Yet it has so far escaped the notice of Jay Powell, Janet Yellen, and the other tens of thousands of Ph.D.s we pay, in theory, to understand the economy. So is there a way out? The solution, of course, is staring us right in the face with the debt ceiling, but it almost certainly will not happen. Because if you immediately slash government spending by letting the debt ceiling ban future deficits, that would immediately pull inflation back down. Once it's falling on its own, the Fed no longer needs to try and crash the economy on purpose. That means the Fed could actually start cutting rates to a level that lets the economy recover gradually, rather than doing what it's now doing, which is steamrolling everything in sight, good and bad. If that was combined, now this is pure fantasy, but if that was combined with less government spending, perhaps by laying off the army of regulators we also pay to crush small business, we could actually get an entrepreneurial revival that could pull us out of the tailspin. Now, this is all simple on paper. It is, of course, impossible in practice because we are ruled by a predatory elite who has no idea how business works, little idea how an economy works, and not the slightest interest in learning. Okay, we'll be watching. See you next time.